So yesterday we saw the last day of Q1 2022, and with that the end of the worst first quarter for US markets since 1984, just under 40 years by some metrics. As for yesterday alone, markets weren't great. They fell by and large on a few different things that we will of course cover today. Then we're going to talk briefly about a couple other things that are just worth mentioning, so let's get right into it. So what actually happened in the markets yesterday? Well, they fell, which means that for 2 days in a row now there have been declines. The S&P 500 was down about 1.6%, so not a small amount actually, and the Nasdaq was down by 1.5%, so similar drops for tech stocks. Both indexes saw a pretty drastic rout at the end of the day, leading to those red moments, based mainly on fears about the war in Ukraine that we'll talk about in a moment. Now, as I just said, today is April the 1st, that first quarter is done, and despite what it may feel like because the last 2 weeks have been mostly green, the markets have really struggled, and over 3 months the S&P 500 has now returned -5%, and the Nasdaq has now returned -10%, which is really quite a poor quarter based on basically 4 different fears. The first big fear is monetary tightening, the second is the Ukraine war, the third is the energy crisis as a result of the Ukraine war, and the fourth is the looming recession as a result of all of those other problems. Now, as we move on into Q2 and the rest of 2022, these are going to be the main focuses for markets that we need to pay attention to and monitor for our investments. Now, for yesterday alone, for bonds, they didn't see too much volatility actually. The US 10-year Treasury yield fell 2 basis points and now sits at 2.33%, still very high as usual, and gold is pretty much exactly where it was yesterday as well, sitting at $1,940 an ounce. Once again, there are rumors that Russia has pegged the ruble to gold by offering to buy and sell gold at a fixed price, but this is not true. They are only offering to buy gold at a fixed price, and that price is well below the market value of gold. So no, that isn't a peg, and it isn't responsible for the ruble's rise over recent days. So now, what are these developments regarding the Ukraine war that are shaking investors a little bit? Well, there are a couple. The first is this standoff between Putin and Europe about paying for gas in rubles. Both sides are refusing to do what the other side wishes, and it's not clear who will blink first as of yet. If Europe remains firm though and refuses to pay for gas in rubles and Putin does the same, as they are both claiming they will do, there will be a natural gas shortage across most of the continent, and a recession is very likely to follow within a few months. This would be bad for markets and investors, so there is some worrying going on surrounding this. If Putin blinks first though, then gas keeps flowing and the markets will react positively, as there just wouldn't be much of a problem. Now, the second thing that may be worrying some investors is related to the war, the conflict itself, and the fact that it isn't actually winding down. A few days ago, we all know now that Russia said they were going to withdraw troops, and then they launched a load of extra missiles at Kiev and Chernihiv, and we do now think that troops have mostly withdrawn from west of Kiev, but this is after 2 weeks of concerted counterattacks by Ukraine and heavy losses by Russia, so likely not a decision made in easy circumstances. Another escalation to this conflict is that Ukraine sent 2 helicopters in a raid into Russia yesterday and blew up an oil storage plant, which is an escalation by Ukraine, taking the war into Russia against Russia itself. Putin will almost definitely feel the need to retaliate for this, so the idea of the war slowing down is sort of on hold right now, and that is bad for markets who have been pricing in the war winding down recently. Now, once again, a quick note on meme stock madness that has picked up recently. GameStop announced a share split and the shares rose by 15% almost instantly on that news. We've covered share splits recently, but in short, this movement is very large. There is loads of volatility and this isn't a rational movement at all, but it's GameStop, so what do you expect? Also, I just want to quickly say that the GameStop and AMC video is still coming out shortly. I've just been having to keep adding to what I'm going to say on that video each day as the situation keeps evolving, so rest assured I'm not ignoring that at all. Now, oil has been a hot topic recently, of course, and we saw another decline in oil prices yesterday, which is great to see. Let's just hope it continues. Now, WTI crude oil is now sitting at $100 a barrel, and Brent crude oil is sitting at $104 a barrel. So why did we see this decline? Well, the US announced it will be releasing 1 million barrels of oil from its strategic reserve per day for 180 days, which is basically the equivalent of increasing the supply of oil in the US by 10% for 6 months. This will help to ease oil prices. By how much, we really just have to wait and see though. I also mentioned yesterday that if some other countries do the same thing, I said in particular Japan, the UK and France yesterday, then that will help to ease prices further, and we could actually see prices drop back down to reasonable levels. And literally one day later, the UK announced that they will follow the US's move and release some oil from their reserves as well. Hopefully many more countries come through and do the same thing, and we can see some downwards pressure. Now finally, what happened in the crypto market then? Well, we actually saw a slightly red day for a change as markets dipped a little bit. Bitcoin and Ethereum are both down about 4% from yesterday, currently sitting at about $45,000 and $3,300 each. The altcoin market saw similar declines, with most falling 1 or 2%, all the way up to 10% for some of the biggest fallers. Now recently, when we've seen crypto moves, there haven't really been many specific reasons for these dips or these rises, no specific triggers that cause inflows or outflows, but here we do actually have some bad news for the crypto markets here, which might go some ways in explaining this slight drop. So what is this news? Well, the European Union backed a plan that would mean crypto transactions would have to abide by the same financial reporting requirements as traditional finance, which means that basically the two people transacting coins would have to have their identities recorded. This is obviously a fairly restrictive rule for crypto in the EU. When two wallets trade crypto or whatever else, we know their addresses, but we often don't know who or where those addresses are or who they belong to. Now, what I don't understand here is how the EU plans to enforce this rule at all. The EU doesn't know where these transactions are taking place, they don't know if they're in or outside the EU, and because trading peer-to-peer between two random wallets doesn't require an intermediary like a bank, there is no individual entity mandating that this information be recorded. I just really don't know or understand how the EU plans to enforce this rule at all, so if anyone can shed some light on this, please do let me know. I suppose this will have an impact on transactions between exchanges or certain wallets that are run by corporations, as then there is that authority that the EU can pressure, but this will not work at actually stopping money laundering with crypto because it will be so damn easy to bypass, so it's totally pointless. Nonetheless, it's an unnecessary and awkward legislation for the crypto industry in Europe, and it's been perceived quite negatively by markets, so markets are dropping a little bit. Why are markets reacting to this if, in my opinion, the policy won't actually be effective? Well, because the vast majority of crypto users do use centralized exchanges and hosted wallets, so it will impact them and force them to give up a layer of anonymity, which is annoying and not good. But again, if people want to get around this rule, they can do so with very minimal effort. Now, really quickly, there are a load of more problems in China popping up right now, like for instance a tech crackdown against the streaming industry. Just as I predicted, the CCP is not stopping their regulatory attacks. All of this and more though goes really deep, there is loads of nuance at play, and so really this topic needs a video all on its own to do it justice, so look out for that in the future. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so make sure to check that out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thanks for watching, stay stoic. Until next time.